Hey, good day everyone. Bert Salazar here. Welcome to the Cambridge world. Obviously at Cambridge there are three major areas we specialize in. Number one is tax planning, number two is insurance and risk management, and number three are investments. One of the topics that I want to discuss with you today is the area of making contributions to 401k plans. Obviously, during tax season, many of my clients come in to talk to me and to talk to our advisors regarding the tax planning and what they're doing from a taxable standpoint. And the major question is, does it make sense for you to be able to maximize your contributions to your 401ks or your IRAs or any type of qualified plan or pre-tax qualified plan that you may have in the marketplace or that is provided to you through your company or your employer? It's a big issue. It's a big question. And I always try to use analogies with my clients. So one of the analogies that I use with my clients is, look, in a traditional 401k, the money that you put into your 401k is pre-tax. In 2018, you have the ability to make contributions of $18,500 to your 401k, and if you happen to be age 50 or older, you have what is known as a catch-up provision, which gives you the ability to put away another $6,000 a year toward your retirement. So total contributions, if you happen to be at least 50 years of age in 2018, would be $24,500, and that doesn't include any type of match that you may get from your employer. Now, there are some companies out there that provide a 401k to their employees, but they don't provide any type of matching whatsoever. Where you need to be careful is that when it comes to accumulation, when you're looking at retirement, there are two sides that you got to look at. You have the accumulation, and then you have the distribution in retirement. Think of it as if you're climbing a mountain. And many a times when I use this analogy for my clients, the one question that I ask always is, well, if you were a mountain climber and you want to climb Mount Everest, what is the goal of each and every one of those mountain climbers that want to get to Mount Everest and they want to have the ability to climb it? Well, their goal is, most of the time, my clients would tell me that the goal of a mountain climber is to get to the summit, to get to the top of the mountain. I argue that that's only half of the goal. The goal is not only to make it to the top of the mountain or the summit, or in our case, in our discussion, to get to your retirement age of 65, 67, 70, whenever you decide to pull the retirement trigger, but also to make it safely back down. As a matter of fact, over 70% of the people that have died on Mount Everest have not died climbing or going on the way up. They have actually died on the way down. So the same thing happens in retirement. While you're working and you're putting money away in your qualified plans, your 401ks, IRAs, and so forth, you're actually climbing the mountain, hoping to get to the summit in retirement. Once you get there, obviously you want to have plenty of assets, and there's a lot of other conversations that need to be had when it comes to retirement distribution planning. The second half of your life is coming down the mountain in retirement. And you have to be very careful, because in retirement, you don't want to run out of money before you run out of life. And the vast majority of the clients that I have engaged for the first time, they're more than likely going to run out of money before they run out of life. So if getting old is bad, getting old and having no money whatsoever, it's even worse. Now, what are some of the things that will cause you to run out of money? Obviously, inflation is a major issue in the United States. Taxation is a major issue. We have an 8-year window under the new tax law that has been reduced. So if you're going to do any type of retirement planning and you want to get to the summit and then make it all the way through on a tax-preferred basis, you have to start doing the planning today. You cannot wait 6 or 7 years to do so, because you're going to run out of time. Under the new tax law, on the individual side of the house, everything sunsets in 8 years, which means that unless Congress decides to do something else and they decide to extend the period of tax benefits in 8 years from now, January 1 of 2025, everything goes back to the old law that we had in 2017 where taxes were a lot higher. The other question that you need to ask yourselves is not only about yourself personally, but the overall atmosphere in the United States. And the big question is, where do you think that taxes are going to be in the future? Where do you think that taxes are going to be in 10, 15, 20, 25, 30 years from now? We, as a matter of fact, last week we just hit the 21 trillion mark. When it comes to our national debt, that's an enormous amount of money, and we just keep adding money to that. So at some point in time in the future, someone is going to have to pay the piper. And the piper comes and increasing in tax rates, increases in tax liability, perhaps even reduction in Social Security benefits or whatever that may be. But at the end of the day, we should not allow any governmental agency, any politician to dictate what our tax bracket should be in retirement. Whenever I have these conversations with clients, one of the main questions that I ask of them is, look, once we do all these calculations and you get to that summit and you're ready to retire, now you go from people at work to money at work. So you have to make certain that your money is working for you very effectively and very efficiently if you actually want to make it all the way through onto the day that you pass away. And most important, you also need to make certain that upon your death, your family is well protected from a business perspective. So there are a lot of issues when it comes to retirement distribution planning that everyone needs to pay attention to. Now, the other issue and concern is that as you're putting money away in your retirement plans, you have to be very careful because during your accumulation years, it's all about the internal rate of return that you can get on the specific plans that you may be investing in. When it comes to retirement and when it comes to your distribution stage, that stage that you hit the summit and all of a sudden now it becomes money at work and you start to use the money that you have put away in retirement in order to maintain your standard of living. It is no longer about an internal rate of return on the accumulation side. It is now a distribution rate of return. So the higher the distribution rate of return that you can acquire, the better it's going to be for all of us. I think that the big issue with putting money away in your 401ks is that many of my clients and most Americans just put money away to try to save taxes today. And many of the accountants that I deal with or that I have discussions with or many of the clients that we engage, they tell us that by putting money away in a 401k or in an IRA, they're actually saving money on taxes. And that is totally untrue. When you put money away in a 401k or an IRA, or if you happen to work for an employer and you have a defined benefit plan, or if you happen to be a public employee and you put money into 403bs or deferred compensation program, or if you happen to be a public safety employee that you may have a deferred retirement option program, you are not saving money on taxes. You're not saving anything on taxes. All you're doing is you're postponing the tax. And that may be well and good today, but the problem with postponing the tax is that you're also postponing the tax liability. So remember, what belongs to the IRS will always, always, always belong to the IRS. If you put $10,000 away pre-tax in your 401k and you happen to be in the 30% tax bracket, you have actually put $10,000 away, but $3,000 of those dollars belong to the IRS. And as you're getting an internal rate of return, the internal rate of return is divided in two parts. You will get your internal rate of return on the $7,000 that you put away pre-tax, and the IRS will get an internal rate of return on the $3,000 that you put away on their behalf, whether you want to see it or not, and they will continue to get that for as long as you continue to put money in a qualified plan. So when it comes to retirement planning, you have to be very careful. The big question is, where do you think you're going to be in retirement? Do you think you're going to be at the same tax level that you're today? Do you think that you may be at a higher tax bracket? Do you think that you may be at a lower tax bracket? Many individuals and clients that I talk to, because we do, webinars on a regular basis, and we do podcasts, and we do a lot of information. We also do education. I'm a certified financial education instructor, so I provide education when it comes to finances on a regular basis. Most of the questions that I get is, well, Bert, isn't it true that by the time I retire, or when I do retire, I'm going to be in a lower tax bracket? The answer is twofold. Number one, if you've done proper planning, if you have done provisional income calculation, or you have used a firm like Cambridge in order to set you up for a tax-free retirement life, there's a high probability that most of us are going to be in a much higher tax bracket than we are today. One of the main reasons, and regardless of where taxes may be in the future, although I am a true believer that taxes are going to have to be higher in the future in order to pay the mess that we're in. But the problem is that some of the deductions and exemptions that you have today while you're working and you're raising a family, you're not going to have at the point in time that you retire. So even if you maintain the same level of income, your tax liability may increase because of the fact that you have no deductions, credits, or exemptions assigned to you and to your spouse as well from a retirement standpoint. So those are some of the issues that you need to consider. The other thing that needs to be considered is that when it comes to retirement distribution planning, 401ks and IRAs are a horrible, horrible retirement distribution plan. Think of it this way. The average American lives anywhere between 84 years of age and 85. If you put money away in a 401k or in an IRA, out of 85 years of life, you only have flexibility with your retirement plans for 11 of those years, between the ages of 59 and a half and 70 and a half. The reason for that is if you take money out of your qualified plans prior to age 59 and a half, unless you fall under one of the exigent circumstances, you're going to have to pay not only taxes on the distribution, but you're also going to have to pay a 10% penalty on that distribution. And then at age 70 and a half, so between 59 and a half and 70 and a half, you can do whatever you want with your 401k and your IRAs. You can leave it where they're at. You can pull money out 1 year. You don't have to pull money out the following year. So for those 11 years of your life, you have access to do whatever it is that you want to do. When it comes to the age of 70 and a half, you fall into the IRS rules, which are now called required minimum distributions, or RMDs, which means that whether you want to or not, you're not going to have any other choice that at age 70 and a half, you're going to be forced to start taking money out of your 401ks and IRAs, whether you want to or not. More important, if you don't take money out of your qualified plans at age 70 and a half, not only will you have to pay federal income taxes on that portion that you should have taken out that you didn't take out, but most important, you're going to have to pay a 50% penalty. Yes, I know, you heard me right, a 50% penalty on that distribution that you should have taken out that you didn't. So you have to be very careful. The other thing to consider, and I'll close this video, is that there's something called provisional income calculation planning. Now, unless you're a firm that does tax planning like we do, the vast majority of financial advisors out there in the marketplace don't pay attention to this. Most of them don't even understand it or may not even know about it. Obviously, the vast majority of my clients have no clue as to what I'm talking about until I actually explain it to them. When it comes to retirement, qualified plans can hinder your tax liability, not only on the taxes that you're going to have to pay on the withdrawals of those IRAs and 401ks in retirement, because they would all be taxable unless you do proper planning. But most important, your Social Security benefits, which would otherwise not be taxable to you at all. If 100% of your income in retirement was Social Security benefits, or were Social Security benefits between you and your spouse if you happen to be married, if 100% is Social Security benefits provided, then you would pay no federal income taxes on that Social Security benefit. But Social Security in itself does not cause a tax liability. What causes the tax liability is all the additional income that you're going to be taking out during retirement, that it's going to compound or exacerbate your distribution of Social Security. What do I mean by that? Well, provisional income calculation, simply speaking, when you get ready to do your taxes once you're in retirement, they're going to take 50% of that Social Security benefit. So if you have $40,000 coming in Social Security benefits, they're going to take $20,000 of that. To that, they're going to add any distributions, any withdrawals you have from your 401ks or your IRAs to maintain your standard of living. On top of that, if you happen to be working part-time, you're going to have to add that as ordinary income. Also, if you had capital gains in that given year, where you may have sold a stock along those lines, now you have to report that capital gain, and it gets added onto the provisional income calculation. And then last but not least, any distribution you may have had from municipal bond funds. Now, most people will say to me, well, Bert, municipal bond funds are federal income tax free, and the answer is yes. If you did it properly, municipal bond funds would be received federal income tax free. But the amount that you receive from municipal bond funds will be added on to the provisional income calculations in order to determine how much of your Social Security benefits and that of your spouse will be taxable in retirement, depending on the threshold. And we're not going to get into that one today, but depending on the threshold of all that entire income, your family may pay either 0% on Social Security benefits, 50% in taxes on Social Security benefits, or 85% in taxes on Social Security benefits. So always bear in mind that putting money away in a 401k or in an IRA has negative impact for many, many years to come on the distribution side, because not only will it impact the taxes that you'll pay on that distribution from your qualified plans, but it may also cause a percentage of your Social Security benefits to be taxed. It will also cause a portion of your capital gains to be taxed prematurely, because capital gains do receive a better benefit than traditional ordinary income tax rates based on the tax tables. And your municipal bond funds are going to compound the problem. There are only 3 products under the IRS code in which it has no negative impact whatsoever on Social Security distribution. And those are your Roth IRAs, your Roth 401ks, and your personal insurance retirement programs or life insurance under IRS code 7702. We'll get into more details as to how these plans work, and I will continue to provide you with information, because at the end of the day, we here at Cambridge feel that information without education always leads to failure. And my job and that of my firm is to help you change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, thank you for giving us a few minutes of your time, and we'll talk to you soon.